creative and marketing, but my understanding is there's also a lot of financial institutions. Okay, so Bitcoin. I would say 2017 was the year of Bitcoin. I first started talking about Bitcoin, I would say in early 2014, but it was largely because of my students. They were coming to me, my undergrad students, 20-something, saying, hey, we want to learn more about Bitcoin. And so, I've been talking about this in the classroom for several years, but I would say this right here is part of why I'm here today, just to be honest about this. So this is the fall and winter of last year. You can see the price of Bitcoin down here below 5,000, and then this just ramp up to 20. Really started showing up in the headlines. It's I found it interesting. I require the Wall Street Journal for my students, and I was telling them, you got to learn how to follow the stock market, learn how to follow the bond market, and the Wall Street Journal, would often report these things on the front page. Bitcoin and sort of the current price of Bitcoin started showing up more frequently, even on the front page of the Wall Street Journal. And so papers like USA Today, Chicago Tribune start talking more about Bitcoin. Chicago Tribune came to my class and did an article on Bitcoin in the classroom. So this, I think, was why so much attention got drawn to this topic. But then what's interesting is, some of you are probably familiar with, then 2018 begins and you get this plummet here, and then this sort of just bouncing around between 5,000 and 10,000 since then through the spring and summer. And so during this period, many people like to say, ha, told you so. It's all a bunch of junk. This was a fraud. And so there was a lot of excitement, and here started capturing, what is this thing? This is interesting, this is cool, and then, oh, well, maybe this is not what I thought it was. So this is not, and by any means, the first time this has happened with Bitcoin. This is the history of Bitcoin. It goes through these spikes and plummets. Some of my students have done research on various episodes of that period, but what I want to try and help you understand is not so much the valuation of Bitcoin. There's a lot of debate about, what is the true value of Bitcoin? Should you be buying it today? The focus of this audience, that's more what we did in the May event. I want to help you kind of think about some of the origin of Bitcoin, and then how you can understand some of the basic concepts. And just to help tie this into blockchain as one more piece of motivation, as I mentioned, there's a lot of people who are now kind of jumping on the bandwagon of bashing Bitcoin. Jamie Dimon, CEO of JP Morgan, back in early fall 2017, Bitcoin is a fraud. He's since retraced that somewhat. I feel like Jamie's a bit uncertain about how he feels about this stuff. And JP Morgan is very much exploring applications of blockchain. Warren Buffett at the Berkshire Hathaway annual meetings in May said it is probably rat poison squared. So not mincing words there. And then Bill Gates, right around that same time, as an asset class, you're not producing anything. And so he was very dismissive of Bitcoin. He said he would short it if he could, and just, there's a lot of people, notice kind of older, more traditional financial types were very skeptical. I've drank the Kool-Aid. I think this stuff is going to transform financial services, but I tend to be over-optimistic in general. So, maybe I'm a little bit too optimistic on this stuff. And when I ask my students, is the money of the future, it's about half and half, which is actually kind of surprising to me. I would think, like, with millennials, of time, and there are thousands of years preceding us in which money looked quite different than what it does today. And I think probably most of us are familiar with gold. You know, we often talk about gold now as this kind of rare metal that some people may invest in, as like a safe investment safe haven. You know, gold originally functioned as money, and you could think of like literally like rocks, but then gradually we started moving towards more of coin-based societies where we started taking metals, gold, silver, copper, and started beating them into these discs because they were easier to carry, they were easier to denominate because they were standardized in terms of their unit of value. You could carry them, use them. But then think about, you know, the transition from metal to paper. And at one point, the US dollar, which most of us think of when we think of money, was based on the gold standard. And so up until the 1970s, under Richard Nixon, you could redeem a paper IOU for a piece of this gold metal. And that was considered an anchor for the value of this paper. Part of that was based on trust. How do I know this paper is really worth something? Well, it's backed by gold, and we believe in gold. Under Richard Nixon, we went off the gold standard. The US dollar is now what's called fiat currency. It is only legal tender by decree. Okay, it's, you know, money doesn't have fundamental value in and of itself. There's nothing about water and wood pulp that gives, you know, a piece of paper value. What gives this value is that it's backed by the US government. And so really our system of money has shifted in from like kind of commodity-based money to government-based money. And so there's this linkage now between government and money that we just kind of take for granted. But that hasn't always been there. So when we think about how money has evolved, many people talk about, well, what are the two characteristics of money? These are straight from my undergraduate textbook. Money is a store of value and a means of payment. Now, you can think of something being stable as like I'm gonna put my money in cash because it's not going to lose value, and I can use it to buy stuff. Now, clearly the US dollar fulfills these two characteristics. As it would say, well, it's too volatile to be money, and it's not really used to purchase things anymore. You know, there's funny stories about somebody who bought a pizza with Bitcoin. And it is questionable whether Bitcoin really fits these characteristics, but I would say I'm not sure where that speaker is, but I'm not in the right place. Cryptocurrency has the potential to fulfill these. And so the question is, how do we get there? Now, the trend towards cashless societies is a phrase that's often used now. I mean, that's already here in Chicago. So I don't know if you guys have followed the stories. Argo Tea, Epic. Into an Epic Burger and purchase food with a dollar bill. They won't take it. Epic Burger has decided, the CEO, that cash is too problematic. You have to deal with it. There's a transaction time. Have you ever had people who start doling out dimes and nickels in front of you? Security issues. They have robberies and break-ins because they have cash on site. He feels like it puts his employees at risk, and so he prefers to have no cash on site. And so I would say that this move towards is very much present. Sweden is way beyond us, but now the US is moving also in that direction. And think about how most of you now pay, debit and credit card. You know, I joke with my students, you know, that's about as hipster as I can get. You know, I have the wallet in the it's like a brick, you know, carrying around. Because that's, you know, that's that generation. Should I skip for this? I'm not sure what I'm doing.
The mic audio is good on the...
Okay, maybe I'm getting too excited. And so many of you probably don't even carry cash. It's just, you know, you don't need it. In terms of money, but I would argue that this is not cash. This is a means of payment, but this is an account. It is a debt account. This is a debit card. It's still through my bank account. It is a debit transaction. I'm not paying directly with this. And so part of what I want to motivate my talk with this morning is I think we need digital money that looks more like cash and less like payment cards. And that's where I think Bitcoin is the next step. We're still so wrapped up in all of these bank products that I think the birth of Bitcoin is the internet. So you may have heard this name, Satoshi Nakamoto. This is a pseudonym. People don't really know who this person is, whether it was a group of people. But the reason I bring this up is the birth of Bitcoin is really the Satoshi Nakamoto white paper. So if you came here today and you're curious about this stuff and you want to learn more, I would encourage you to read this white paper. It is 8 pages. I assign this to my students, graduate and undergraduate. Most of my content today is actually drawn from that white paper. And so it's, I think, very useful place to start if you want to learn more about this stuff. That white paper, the title of it is Bitcoin, a peer-to-peer the real innovation of Bitcoin. Many people use the word disruption, which I think it is. You can see in the opening line of this white paper. Commerce on the internet has come to rely almost exclusively on financial institutions, serving as trusted third parties to process electronic payments. So commerce on the internet. Think back to like the dot-com era, early 2000, eBay. Or Amazon. But one of the problems was, how do you pay each other? You know, I'm sending goods to you. How do I make sure you're sending money to me? That was the birth of PayPal. You know, we like to think of Elon Musk as Tesla. Elon Musk was one of the founders of PayPal. And so he solved that sort of... PayPal was an amazing innovation, but PayPal is still backed by financial institutions. You know, you link your accounts to PayPal and it becomes a portal for this that is more secure than you doing it yourself. And so it's still very much about debit cards and credit cards, bank accounts. Bitcoin wants to break even that leverage and say, how do we do this without these trusted third parties? Remember my comment about trust. Money requires trust. We give this value because ultimately we trust the U.S. government, that it's going to be there tomorrow, that people are going to continue to use this. One of the big questions with this type of money, this isn't the government, these are private enterprises, these are financial institutions, but I trust that Barclays is going to function as a financial intermediary when I want to make payments with my credit card. And so this electronic payment system is really the interbank network that is interwoven with as trusted third parties. Notice the contrast with this, peer-to-peer versus third party. There is no third party here. And so part of what Bitcoin is doing is how do we have money on the internet without third parties? And think about the timing of this, November 2008. During the heart of the financial crisis, bankruptcy of Lehman, September. Banks are failing, banks are being bailed out, central banks are printing money like crazy. And so this was also part of why Bitcoin took off, was the timing of people were looking for an alternative. 10 years past, we're now already getting comfortable again. And so we're kind of like, why do we need Bitcoin? What we got, it kind of works. But think 10 years ago, we weren't entirely sure. And so it did, the crisis, this white paper, it raised this question, how do you have digital cash, not electronic payments, digital cash without bank accounts? And so, when this really started to get going a few years ago, there was a lot of discussion about, is Bitcoin going to replace banks? Is it going to replace sovereign currency like the US dollar? Now, I'm not that sort of enthusiastic. I think these are going to work together. It's not either or, but I do think this makes a lot of sense in terms of the evolution and history of money. We need cash that can function on the internet. And so the question is, how do you do that? And this is where I want to hopefully help you understand some of how Bitcoin works and how it relates to blockchain. So as I said in the title of that paper, Bitcoin allows for peer-to-peer, P2P transactions. So it is not through a financial institution. When you think about swiping a credit card or debit card, there's a pause. Why is that? Because it's pinging your account and you have to be approved to make sure that the money is there. And so it requires that third party. It's not just me and the merchant, it's me, my bank, and the merchant. Notice cash, it's boom, right there, peer-to-peer. Without a bank. And so the question is, how do you do that? Well, the challenge, the reason this hadn't been done before, is that you have this thing called the double spend problem. So let me give you a couple analogies and then maybe try and help you understand this. So think about counterfeit money. I used to work for the Federal Reserve. If you ever get a chance, you should go to the Chicago Fed. They've got this basement full of cash and robots moving these huge plats of cash around. A large part of what they do in the basement of the Chicago Fed for the Midwest is processing cash, partly just making sure it's all moving in the right place, cleaning it, replacing it. A big part of it is checking for counterfeits. That if I could somehow duplicate this $5 bill, I can now spin it, give it to person A, buy something over here, give it to person B, buy something over there. That would be a double spend, because I have now duplicated something falsely. Well, the problem, think about how easy it is to duplicate something on the internet. Think about a PDF. Copy from this folder, paste into this folder. I now have two versions of the same document. And so when in an electronic form, duplication is even easier. And you can think about that like with Napster. If you guys remember that, like, you know, back, I guess maybe early 90s, that was P2P music. And it was all about file sharing. And the issue was, you take like an MP3, and now you just, anybody has it, and anybody can share it, and now nobody actually owns it anymore. Not the artist, not the record company. And so it created these problems in the music industry. Well, if you think about that with money on the internet, that would be a huge problem, because I have no idea if that $5 bill is real or not, whether you actually own it, whether I should receive it in exchange for something. And so it would stop the function. And so what you need is a verification process. Just like that approval that shows up on your point of sale, okay, you're good, now you can leave the store. In this case, who will verify that the money is there? So even though we're not talking about banks and bank accounts, we are still, in a sense, talking about, you may have heard of digital wallet. So there's still this idea of like, I own Bitcoin. It's not in my pocket, but I have a digital wallet. If I want to use that Bitcoin to buy something or to sell it to someone else, who verifies that it's literally in my wallet? This is not paper anymore, and there's no bank to do that. And so you need some sort of technology to provide that verification process. That's blockchain. So hopefully now this is where it starts to tip from cryptocurrency into blockchain. Blockchain is a technology that's sort of the foundation for this entire process in Bitcoin. And let me take that a step further. So these are quotes directly from the Nakamoto white paper. So again, this is not me getting super creative with this. This is just me trying to go back to primary sources, help explain how that relates in easier language. When they describe Bitcoin in that white paper, they say, we define a coin as a chain of digital signatures. Well, that's kind of weird. Like when I think of coin, I think about a round metal disc. Ultimately, money is about recording. You have value in that account, debits and credits. Money and where it is. And so this and how it's transforming accounting. Well, the root of that is money is the digital ledger to record who owns what. Big ledger. But the question is, what about this double spin problem? Who keeps track of the ledger? That's what banks do. They're basically bookkeepers to make sure that your money is where it's supposed to be, and then when you can use it accordingly. There is no bank here. So who does that? Who keeps track of a ledger? This is the radical part of Bitcoin. To accomplish this without a trusted party, transactions must be publicly announced. Think about how private money is. When I spend my money, I don't want you knowing about it. It's me, the merchant, and the bank. Especially cash. That is the beauty of cash. If you think, cryptocurrency is weird and opaque, cash is where it's at. Because there's no tracing it. There's nobody else involved. It's just you, me, and the cash. here, we're going to make this public. That's weird. But the idea is, rather than having separate ledgers managed by these separate third-party institutions, let's have a single ledger. And let's just make it publicly, where this is now common knowledge. Now, if that, gets weird, I guess I don't even need this. If that gets weird, part of what I'm going to explain on the next slide is the difference between a public key and a private key. If you spend Bitcoin, no one knows, oh, well, John, I can look at the ledger. John paid Sue to do this. It's not public in that sense. But it is public in the sense of party A has transferred Bitcoin to party B. I don't know who A and B are, but everyone. The reason that's so important is because now there's no question about where the Bitcoin is. It's not with A anymore, it's with B. Everybody can see it. There's no debate. The question is, well, who sort of manages that ledger? Who forms the consensus? The idea of the old school idea of money is we have these green shade accountants, and they kind of like keep the books over here, and you keep the books over here, and if A wants to party with B, then we check and we say, okay, and then we update our own books, and then we build these firewalls around them to make sure they're secure. Now we've got one ledger that sits between them, and A and B are transacting, it's being recorded on this ledger. Who forms the consensus, the agreement that this is the record of truth? That's this step. We need a system for participants to agree on a single history. If we have a chain of digital signatures, we only want. We need a system for people to agree on that history of the order in which these transactions were received. You may have heard of something called mining. You might think, like, what is that? Bitcoin miners, you hear about these huge, server farms in China and all the energy that's being used. That is this. And mining is that they are basically playing the role of the verifiers. But it's not an assigned role. It's not delegated in the sense of, okay, well, you guys, we're going to trust you to do all the mining, and then we're going to do our stuff over here. Anybody can be a miner. It is a community function. So it's not like this governance mechanism. And everyone agrees. I would say it's more like a voting process. Some people refer to this as the democratization of money. So we could have our own money in this room, but we would just have to figure out a way where we can agree on how we're going to keep track of them. Blockchain is referred to as a distributed ledger technology. Meaning, instead of us saying, okay, well, this table over here, you're going to be the bookkeepers and you're going to be the merchants. It's like we all agree, okay, we're going to have a single ledger that we can all see and agree upon, and then we are going to keep that ledger together. It is a community. And this is where I think a lot of the more radical types get very excited about this, because there's no bank, there's no government. It is the community itself that is keeping this ledger. I'm starting to run low on time, so I'm not going to be able to go into details here, but let me hit a few highlights. How does this work? I gave a presentation at a family reunion a month ago, and I had my aunt and uncle. They were like grilling me. They were like, "No, I want to know, how does it work?" And so we spent a long time on this slide. I was like, "Dude, can I just go get some lemonade? Come on." So first of all, Bitcoin is a small part. Crypto is not dark. It's on cryptographic proof. You sometimes hear that miners are like solving some math problem. When I first heard that, I thought like, well, what is that? Is that like algebra, geometry? Like, that sounds really weird. What they're solving is a cryptographic encryption system. And so, again, because we're making this thing public, it needs to be encrypted. So rather than having separate ledgers and trying to build firewalls around those ledgers, let's have a public ledger that is encrypted. That's cryptocurrency. And so we have this distributed, remember, distributed ledger technology, synonymous with blockchain, a distributed timestamp server to generate computational proof of the chronological order of transactions. And so the mechanics of how this works, if you do want to transfer value, move a Bitcoin, this chain of signatures is signing two things: a hash of the previous transaction and the public key of the next owner. So the reason that the term chain is used, and really the role of these miners, if you think of this as a block, blockchain is a sequence of blocks that are chained together. What the miners are doing, that's so important, because if you think about a ledger, you need things to line up. If A is going to transfer value to B, you have to make sure that that is through the history of transactions. History, then you know exactly where the money is. And therefore, mining is about taking the new transactions and lining them up with that history. That creates a chain of blocks. That is the blockchain. So you sometimes may have even heard this phrase, proof. Basically a consensus mechanism in which there is verification of, okay, yes, yes, boom. Everything lines up. It's like an accountant. It's like an audit. But it's not a delegated auditor. It is the community auditing its own network. How are we doing? By hashing them, this is the mining process, into an ongoing chain that cannot be changed. That it came from the largest pool of community, verifying it.
I mean, it's very polarizing in that way. And so it just, you know, I think maybe it's my hippie roots, but I'm just like, yeah, buddy, power to the people. But, it, you know, not everyone feels that way. I understand. Works for money. You can apply that same logic to just about any sort of financial asset. Rely on separate. NASDAQ is using it. I think auditing cryptocurrency, I didn't get into that. That's not Bitcoin itself. And then they get hacked. There's no bad guy who can somehow then just come in to on the blockchain. So this is not just all fairy tale, you know, head in the cloud stuff. There is a lot of experimentation on enterprise applications. So even if you don't believe in Bitcoin, if you're working at a financial institution, somebody at your firm is working on this. You know, it may not be public yet, but I have not met a financial institution yet that is not exploring blockchain applications. And so, so I think it's very important to just understand. So let me give you just final thoughts, and then I'm happy to take any questions. Oh, I've got all this stuff on ICOs. I'm just not going to have time to cover that. I think Chicago is an ideal place for this. This city has a history of financial innovation. You know, like corn futures. Those started in Chicago. The whole derivatives industry, we are innovation. You know, a lot of people think about